Hello, it is a beautiful Monday morning, and hope you guys are having an awesome weekend. On today's lesson, we're going to be talking about stop entry technique for position traders, and this essentially is going to cover an entry technique. So we're covering two entry style techniques. The first one is a stop entry technique, and this is for position traders and swing traders, and the second one would be a limit entry technique for also position traders and swing traders. Again, you can also apply this to a lower time frame, but because we are dealing with macro analysis and higher time frame analysis, so this is going to essentially cover entry technique for more of a position style trading or swing style trading using the daily candles. Now, if you go back to the first module, we talked about a trader's profile. Okay, so trader's profile essentially is your appetite for your approach to trading. Okay, so it could be a position trader, it could be a swing trader, it could be a short-term trader, it could be a day trader or a scalper. It depends on your number one, your appetite, and also number two, it depends on your lifestyle. Okay, so lifestyle can influence your style of trading. If you're someone who barely has time, let's say you're on the road for most of the day and just not enough time to see in front of the charts and day trade like I do, or short term trade, then you're going to be someone who position trading is going to suit just based off of your lifestyle, or swing trading is going to suit based off your lifestyle. And this part covers this aspect of trading. So again, we're going to discuss an entry technique for stop entry. So if you're a person who, again, you want to position trade or you want to swing trade, then you have stop entry techniques whereby you can place those stop orders and you can go do other things and you can come back and allow the market to withstand. And you also have ample time to react to market information or to validate your trade, so because each candlestick is a daily candle, so that's a lot of time to wait for the market to do its thing, wait for the market to present an opportunity before taking an action. So uh, now what we're going to cover here is we're going to cover buying with stop orders. And before we discuss the technique, you have to remember this is just an entry technique. Okay, it does not cover for your market analysis. That this does not mean that you go into the marketplace looking to buy every down candle in a bullish order flow. Okay, that is absolutely not how you're supposed to use this. This is just only discussing how you can get in sync with order flow once you have defined order flow, and once you've defined where order flow should reaching up or down into. So that takes precedence first. Like with every other analysis, if you don't know where the market is coming from and if you don't know where the market is going to, essentially everything you're doing is null and void. It's invalid because you don't understand what you're doing. Okay, so for you to have an execution, you need to understand what the market actually is doing. So aka understand the narrative. Where's your liquidity and where's the narrative? That's what you're seeking constantly, and you're using all the other techniques which you've discussed in previous videos, like interest rate and SMT and cumulative trades report and open interest. You're using all of these to validate your confirmation of your drawn liquidity by looking at your actual candlesticks. Again, nothing beats the candlesticks. So you're using all these different techniques to validate drawn liquidity on the actual candlesticks, and then you're using that to frame or confirm order flow. And then once you've confirmed order flow and you know where the market is reaching up or down into, then you can then go into the marketplace looking for an execution. All right, so we're going to discuss buying with stop orders, and what you want to do for the sell side is just you simply invert the protocols for buying with stop orders. You invert that for sell side and you essentially have the same thing. I guess I don't want to go through buying with stop orders then selling with stop orders, because you're essentially the same method. So to buy with stop orders as a swing trader or position trader, the monthly and weekly time frames should suggest institutional order flow will be seeking a premium array. Okay, and that has to be above the daily market price. So you're looking for the monthly and the weekly, the willingness in the monthly and weekly time frame to want to expand for a premium, and that's what creates the one-sidedness in price. Because you need that one-sidedness or that anticipated expansion in price for profitability. If there's no anticipated expansion in price, then essentially your bias or your idea is invalid. So you need that anticipated expansion in price. So what you're looking for is, number one, you're looking for the monthly and or weekly time frame to suggest that institutional order flow should be bullish and should be expanding for a premium. So we're gonna do it this way. So number one, look for the monthly and or weekly to suggest one side So you're looking for a clear draw of liquidity at premium. This is the first one you're looking for. And once you've identified or once you've confirmed order flow using these hour time frame tools we've discussed in previous videos, then the next thing you're looking for is you're looking at your execution time frame. So what's the execution time frame for a position trader or potentially a swing trader? That's going to be a daily time frame. Okay, your weekly time frame creates the bias. You can also use your daily premium to identify where the general liquidity is, but your time frame of execution is the daily time frame. And what you're looking for in a bullish order flow is you're looking for the daily candles to post a bearish candle. So you are looking for the daily candles to post a bearish daily candlestick discount. So the first thing you're doing is you're identifying a discount array. Okay, so once you've identified your range of transaction, the range where you define premium versus discount, and obviously you need to be buying a discount, and you're identifying your target around liquidity. It could be a data bearish order block or an old high or a daily rejection block or a weekly rejection block or even a monthly rejection block. It could be any of those things. Once you've identified your general liquidity at premium, okay, what you're looking for is you're looking for the daily time frame to post a down candle at discount. Now, why specifically a down candle at discount? Remember, in a bullish order flow, down candle indicates institutional accumulation, and vice versa for a bearish order flow, up candles indicates institutional distribution. Okay, so if you see a down candle at your discount array, that is indication that institutions are providing buy side liquidity to the funds. And again, the entire point of institution trading is we're trying to position ourselves like the institutions will in price. And so what this means is you are looking to act like the institutions. You're looking to buy inside blocks of price where institutions were provided liquidity by the funds, because you're swing trading. Okay, so once you've identified your discount, because this is where buy side liquidity will be offered to the funds by the central banks, once you've identified your discount array, you're looking for a down candles to post there, or you're looking for down candles leading up to your discount array, and then you place your stop orders there, which we're going to discuss shortly. But you're looking for down candles into your discount array or to form at your discount array, and then you put your stop orders there for a stop entry technique for a buy. And this is what it's going to look like. So let me get rid of all of this. So we have a target liquidity up here, and that we're going to call that target liquidity an old daily high, and that's our target liquidity. And we have a discount array down here, and we're going to assume that discount array to be a, let's see, daily bullish order block. Okay, sorry, this kind of right here is a daily bullish order block, or it could be potentially even a weekly bullish order block. Now, as the market starts to trade lower into the our pre-anticipated discount, what you're looking for is you're looking for bearish candles leading down into your discount array here, and this is what it's going to look like. So again, each of this candlestick is a daily candlestick, not a weekly candlestick. So trades down into your discount array, and what you can do here is you place a stop order for a buy at the open of the down candle. Now the question is why are you placing a stop order at the open of the down candle? Because typically if price runs above the down candle, oftentimes that is sorry. Okay, what's the outcome of a down candle? Bullishness. So if buy-side liquidity was being provided to the funds by the central banks at the down candle, then we should see a result in bullishness. So what you're doing is you're buying inside the body of the down. It's just like you're buying a bullish order block, right? So because we're looking at this as a bullish order block, rather than waiting for the market to trade above this down candle and validate it as a bullish order block, and then retest or trade away from there, and then after trading away from there, having to retest as a bullish order block for a bounce, tradable bounce, and then continue to buy longs. You don't need that. You don't need to wait for the market to then expand away from a discount and then trade back down to a bullish order block and then go for a buy. You're not waiting for that. Okay, this is confirmation of order flow. So once the market trades above your down candle, your stop order for a buy is now triggered. Okay, and then this should look like a bullish candle like this. Should look something like this. All right. So as the market trades and closes with a bearish candle into your discount array, you have a stop order placed for a long, and your stop loss goes below the most recent swing low, and then your target goes up into your premium array. Right. So if the market trades up into your stop order, now you're triggered long and your stop is below that swing, okay, the most recent swing low there, and your objective is the old daily high, and that's what you're aiming for, and that's what your stop entry technique for long should look like. Now I'm gonna use actual price action to describe what I mean with the stop entry technique. So again, this is a chart of USD JPY, and let me actually go back. So we're going to use this chart to identify it's the same chart we've been using with our higher time frame analysis, and you can see here that we have run down into a weekly discount, which is a weekly bullish order block, and I will use a red line. So oftentimes I use a red line for my monthly and weekly levels, just to differentiate. And I'll use black line for daily level, and also black line for lower time frame levels too. Alright, so we trade out into a weekly discount. Market trade lower here into this weekly bullish order block, and what I want you to take note of is the mean threshold of that bullish order block. So mean threshold of that weekly bullish order block is here, and we're gonna make it a dashed line. And we have a premium array here, which is an old weekly high right there. And now we have a down candle here, which is a weekly bullish order block. And then we have another down candle, which is a weekly propulsion block. So we're going to identify all the sensitive points here. So this is the open price of our weekly propulsion candle. This is the main threshold of our weekly propulsion candle. So that's open price, that's the main threshold. This is our target liquidity objective up here. And now we refine down to a daily time frame. So now on our daily time frame, that main threshold of the weekly bullish order block happens to be this daily BPR. So I don't need to draw out the zone there, but you can already see that's a weekly that's a daily balance price range. Our objective still remains up here, and we can take early partials at the rejection block versus premium. So I'm going to use a block line for that. That's the rejection block versus premium, and we already have a shift in structure because this is the last swing guy here, and the market is traded above that swing guy, confirming order flow is not bullish. So we have this as the open of that weekly propulsion block, and here as the main threshold of that weekly propulsion block. But what can we see at discount? Obviously we can see we have a down candle here, which is a daily bullish order block, which happens to fall between the range of our weekly bullish order block open to our weekly bullish order block main threshold. So we don't need these two levels because we can already refine that to a daily level. So we're just going to refine to a daily level as a daily order block, and when the market trades down there, we're looking to be a buyer. But now we don't go in there and buy. We're waiting for a confirmation of order flow, aka using our stop entry technique for a buy. So here's what happens. We have a down candle. Again, this is a discount array because if you measure the range from the low to the high, it falls under equilibrium, which is a discount essentially. So, and you can see this candle trades down into our discount. So what we do here is we place a stop order for a buy here. So there's a stop entry up there at the opening price, not the high of the candle, the opening price of the candle, because we're not interested in the wicks of the candle. We're interested in the body because the body is where the bulk of liquidity is done. Okay, because our assumption here is that if we're going to get in sync with daily bullish order flow, then obviously inside this down candle, institutions are buying. So we want to be in alignment with them, and the market is going to have to prove to us that institutions were buying here by trading through this down candle and displacing higher. So your stop goes below the swing window here. We don't necessarily need to take it all the way down here because this is our discount we're using. So our stop only has to go below the order block, and we can take it back below the main threshold of that weekly propulsion. And our objective one is going to be partials up here, and this is our target liquidity up there. And now this happened. Now what you're going to do here is, do you keep your stop order at the same candle? The answer is no. You don't keep your stop order at the same candle, which is this one, because we have a new down candle. Now, in all of these down candles, institutions are buying, but we have a new down candle, and it's not invalidated our discount array. Why? Because the market has not traded through the main threshold of this bullish order block, so it's not invalidated yet. So what are we going to do? We're going to simply move our entry down into this new down candle at our discount, and our stop remains the same, just below this order block we're using for our validation, and our target remains the same. Again, I want to replay this a couple of times to really understand. So when you get, again, because it's still inside our level where we're anticipating buys to resume the marketplace, so because it's still inside our discount array, it's not invalidated yet. Now, if this candle traded through and closed like this, closed through our down candle, then we would have had no trade. And that's the good thing about the stop order technique. it helps you filter out bad trades for majority of the time. So as this candle straight down here, then this was a missed opportunity, and then we come down here and place our stop order. Now here the market triggers our entry, and you can see how it goes for our first objective and just fall short of our second objective by a little bit, but eventually trades up there and finally trades up into our target objective. And this is how you utilize the stop entry technique for buys. And all you simply need to do is just simply need to invert that for sells, and you get essentially the same thing. Alright, so this video is going to wrap up stop entry technique for long-term trading, and I will see you all on the next video, which we're going to talk about limit entry technique for long-term or position trading. Trade safe.